If you look at the headlines, the stock market is putting on a spectacular show. Equities are soaring, and portfolios look healthy on the surface. But beneath those record highs, the actual plumbing of the financial system is fracturing. Casual investors see companies like Nvidia, Microsoft, and Meta reading an artificial intelligence boom, and it creates the illusion of a continuous era of growth. Tech now makes up a massive top-heavy portion of the S&P 500, but the top institutional money managers, the people running billion-dollar family offices and hedge funds, are looking right past the stock ticker. They are ignoring the equity hype. A green arrow on a screen doesn't mean the economy is safe. A booming stock market cannot indefinitely outrun a heavy financial engine that is struggling to function underneath it. On Wall Street, there is an old, reliable rule: credit leads equities. The bond market historically spots systemic trouble long before stock traders react. And right now, that credit market is flashing severe warning signs across multiple sectors. Corporate bond prices are declining. At the same time, the premium to insure against those corporations defaulting on their debt is rising. To figure out where the next market correction is coming from, we must look past the shiny tech stocks and investigate the massive, struggling debt engine below. There is a direct economic link between national interest rates and corporate bonds. They operate on a seesaw. When interest rates rise, the market value of existing bonds falls. Take Apple as an example. A few years ago, during the zero-interest era, they issued a bond paying a 2.55% coupon. Investors bought it at full par value, 100 cents on the dollar. But today, with interest rates sitting closer to 5%, new debt pays much higher yields. That makes the old Apple bond far less attractive, and the market has pushed its price all the way down to 52 cents on the dollar. Between 2017 and 2021, corporations issued trillions amidst cheap debt. This means the financial system sits on massive, unrecognized structural losses from that zero-interest era. This brings us to the tech giants, the hyperscalers like Nvidia, Meta, Microsoft, and Oracle. The stock market views these companies as the primary drivers of future growth. But the bond market sees a different risk. These companies are pouring hundreds of billions of dollars into artificial intelligence infrastructure, and a massive chunk of that capital expenditure is financed by debt. To measure the actual risk of that debt, institutional buyers use credit default swaps, or CDS. A CDS is a specialized insurance policy that pays out if a company fails to pay its creditors. This graph shows the cost of credit default swaps for Nvidia and Oracle. While the stock market cheers their expansion, the cost of default protection for these specific hyperscalers is climbing, reaching levels that suggest rising caution among lenders. When insurance costs move like this, it suggests institutional debt buyers are becoming skeptical. They are looking at the massive circular debt financing schemes between tech giants and questioning the actual return on that investment. So why doesn't the Federal Reserve simply lower interest rates and relieve the pressure on the bond market? Because domestic interest rates are directly tied to global geopolitics. Right now, maritime conflicts and blockades in the Red Sea and the Strait of Hormuz are creating significant bottlenecks for global shipping. When ships are forced to reroute, it chokes off energy supplies and drives up the cost of oil and crucial distillates like diesel fuel. This creates persistent upward pressure on prices. That inflation traps the Federal Reserve. They are forced to keep interest rates high to combat rising costs, even if those rates cause damage to the bond market. We can already see the impact. Consumer-facing companies, like major restaurant chains, are seeing their stock prices decline and their junk bond spreads widen. The bottom 60% of American consumers are facing significant financial strain. This combination of geopolitical instability and sticky inflation creates a rigid environment for the Fed. With high energy prices keeping inflation elevated, the central bank is effectively forced to keep rates high, tightening the pressure on an economy already heavy with debt. All of these pressures converge to create a mathematical link between the struggling bond market and a potential stock market correction. Trillions of dollars in corporate debt will soon mature. When that happens, companies hit a refinancing wall. They must replace their old, cheap debt with new debt at today's much higher rates. Moving from a 2% interest rate to a 5% rate causes a company's interest expense to more than double. That extra cost eats into their cash flow, which can directly impact profit margins. The bond market is pricing in this math today. Meanwhile, many equity valuations still rely on a future where companies can maintain their current margins, even as their cost of capital climbs. For years, the strategy of leaning into tech-heavy portfolios was supported by global peace, reliable supply chains, and 0% interest rates. Those specific tailwinds are now encountering significant resistance. We are seeing a shift toward a multipolar environment where borrowing costs remain elevated for longer periods, and inflation is no longer a distant memory, but a recurring risk. Navigating this transition often involves moving away from high valuation tech toward companies that control physical commodities, energy, and hard assets. To manage the risk of a market correction, it is essential to recognize a fundamental difference. While stocks often reflect investor sentiment, bonds are a reflection of the underlying